Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. When it comes to building businesses in South Africa, there are few, if any, companies that have the post-democracy track record of PSG. Founded in 1995 and shifting into an investment holding company in the early 2000s, the group is responsible for the likes of Capitec, PSG Financial Services, and Curro. Names like Stadio, CANS Holdings, and Cull Group are all relevant here as well. Now, PSG certainly didn't start all of these from scratch. For example, Cull traces its roots to 1912, when a group of farmers jointly purchased bird manure to use as fertilizer. It's quite incredible how companies like Cull can turn manure into money, while some investment holding companies on the JSE are such experts at turning money into manure. Now, the biggest winner of all in this PSG stable is Capitec, obviously. The company has been an exceptional story of how to win market share, rather than relying on a growing pie in which to participate. Despite the South African market offering very little growth since the global financial crisis, Capitec found a way to disrupt the local banking market. They still have plenty of runway in this regard, as the product suite is still in the early stages of its development. Doing a few things to a very high standard is much better than doing a large number of things badly. And as legacy banks continue to invest a fortune in technology each year just to modernize their systems, Capitec continues to benefit from the fascinating concept of late mover advantage. As the name suggests, this is the benefit of entering a market after others have already done so, which means you get to pick at their weak points. The next time you feel bad about sleeping in, just remember that it can be a competitive advantage to see what everyone else has been doing since 6 a.m. before you plan your day. But the ex-PSG business that caught my eye in the past week is PSG Financial Services, which used to be called PSG Consult. The move from an Afrikaans to an English name, and by the way, I should of course be saying PSG if I'm doing it properly, as well as the obvious broader reference to financial services instead of just consulting, sends a message that the company is moving beyond its historical niche. This is a natural evolution of any company, and niches are called niches for a reason. They tend to be small. You can build a lovely, agile business by focusing on a niche, but you're not going to build a giant, and they are trying very hard to build a giant. A lot of this comes down to an understanding of the benefit of the full value chain and needing to own the client. You see, asset managers are a dime a dozen out there, let's be honest. Yes, there are a few that do something different, but generally speaking, the offerings are pretty similar. This has become a largely commoditized industry, a trend that was accelerated by the widespread acceptance of low-cost ETFs as a great way to add equity exposure rather than the emotions of a specific asset manager to your portfolio. Yes, there are great managers out there who regularly beat the index and put in top quartile performances. There are also many who don't. And a commoditized business is inevitably a race to zero on fees, which means that volumes become critical. Now, how do you drive volumes? Well, aside from pretty billboards and airport ads and memorable TV and radio campaigns, you also need to have advisors out there who are willing to sell your product to investors. Now, of course, this should be seen in the context of the DIY investor trend in South Africa, something that is very exciting, and I'm feeling great about my decision to finally take a long position in Purple Group. But this remains a small part of the overall investment industry. Most South Africans don't DIY it. They are still reliant on a network of financial advisors and complicated product providers, for better or worse. Now, PSG Financial Services recognizes that the best way to play in the asset management game is by being vertically integrated, rather than by sitting back in a cute office with a view of the mountain or a vineyard and waiting for the assets to come to you. That just doesn't really work anymore, with other good examples in the market that prove that point. We can also just look at PSG itself to see where the assets sit. In the results for the year ended February 2025, PSG Wealth, that's the segment with the advisory force, they had assets under management of 410 billion rand, while PSG Asset Management, the pure asset manager, had AUM of 60.7 billion rand, so much, much smaller at PSG Asset Management. Now, I can't tell you for sure what percentage of the AUM at PSG Asset Management has been originated by PSG Wealth advisors. I would wager it's a large percentage. But what those numbers do tell me is that PSG would be a lot smaller were it not for their wealth business, And that's the network of advisors. That really is the strategic win in this group. By owning the client, figuratively at least, PSG gets first bite at the cherry of where their money goes. If it lands in a PSG fund because such a fund is suitable, great. If not, that's also okay, because PSG is getting part of the economic profit pool anyway. In fact, I would argue that they are getting the best part of the economic profit pool. So why don't all the asset managers do this then? Simply because it's expensive and it takes a long time to build that kind of trust. There's a genuine moat here that I think people tend to underestimate. It is extremely difficult to get an advisory force off the ground, and there would inevitably be early stage losses to absorb as well. My view is that PSG is a more defensive business than people realize, and the proof lies in the fact that there are not that many competitors doing it like this at this scale. If it was an easy thing to do, this would also just be a commoditized business, right? PSG has 971 advisors. That is a lot of people and a difficult business model to copy. Now, speaking of defensiveness in the business model, here's the other benefit of having a large advisory business relative to the asset management business. Performance fees were only 3.7% of headline earnings in the year ended February 2025. Now, from a valuation perspective, you would far rather pay a larger multiple on recurring earnings rather than performance fees. A focus on recurring revenue is exactly why I'm now a Purple Group shareholder, by the way, because they've taken a leaf out of PSG's book by building a diversified financial services business with a healthy amount of annuitized revenue. And I like that. I really do. And at PSG, I see so much of that as well. In fact, PSG probably the poster child for this. Now, insurance was the cherry on top this year. PSG Insure might be the smallest segment in the group from a headline earnings contribution perspective, but not by much. In the latest financial year, PSG Insure contributed 16.6% of headline earnings. PSG Asset Management, that did 23.3%, not that much higher. And the rest, which is around 60% if you're keeping score, came from PSG Wealth. So PSG Insure is an important component of earnings here. It also achieved the fastest segmental growth rate in earnings in FY25, up 41.4%. To be fair, insurance companies generally had a strong year in 2024 and early 2025, with net underwriting margins trending in the right direction. PSG Insure's net underwriting margin increased from 9.7% to 12.7%, which is actually a huge jump. Gross written premium growth was 9.2%. Now, I would personally treat the growth in gross written premium as a better indication of sustainable growth in this part of the business, because net underwriting margins inevitably sit in a band. They don't really go outside of that, or at least they don't go above it. They can certainly go below it if there are major loss events. And this is because if insurance companies are experiencing smaller losses, they can then become more competitive on price in order to win market share. And this inevitably stops the net underwriting margin from going much higher. This is why competition is so important in a market for consumers. Now, do I want to own these shares? Well, headline earnings grew 23.1% in the past year. There were a couple of really impressive performances, though, that I am not willing to extrapolate, like the aforementioned jump in insurance earnings of 41.4%. That's not going to happen every year. And an increase in PSG asset management earnings of 36.9%, also not realistic every year. Instead, I look at PSG Wealth and its 14.5% increase, and that's the anchor for my expectations going forwards. In my view, this group is very capable of delivering mid to high teens earnings growth for years to come. Now, what do you need to pay to get this exposure? The group is currently trading on a dividend yield of 2.8%, which is pretty typical of a quality stock on the JSE. Now let's look at the PE multiple, and let's be extra conservative because this was a bumper year. Thankfully, PSG actually discloses headline earnings per share excluding the performance fees, which is just something that makes it a lot easier. And so if we use that, then the trailing multiple at the moment, based on these numbers that were just reported, is 18.9x. If we get even more conservative, and now we're getting really conservative, and we use the previous year's earnings, excluding performance fees, this is hyper-conservative stuff, we get to 23.4x earnings. Now instead, let's put on a growth investor hat, something that doesn't happen enough on the JSE because people are so used to seeing businesses going through tough times. Let's believe in the future a bit. Let's use headline earnings per share, including performance fees, and let's grow it by 15% for a forward multiple view. This gives me a forward PE multiple of 15.8x. Now, these multiples do not put me off, I've got to tell you. And it's also worth highlighting that the share price at time of recording is 12.2% off the 52-week high. Or, put differently, it would be up 13.8% if it returned to the 52-week high from current levels. So, as I look to add quality stocks to my portfolio that I think can withstand difficult times and emerge with even stronger financial positions, PSG Financial Services is making a very strong case for itself right now. I can see myself with a long position here after the Easter weekend when markets reopen. Well done to PSG. This was a strong set of numbers, and I've been watching this group for a while, and it really has been a case of consistent strategic execution, and I love seeing that in a company. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.